How's it going? I'm Andrew with Investors Hub. Glad you decided to visit. And we're talking with Clem Chambers because it's Clem's Day Wednesday. He's the CEO of ADVFN and he's my boss. And I figured I'd chat with him about something that has been on the lips of a lot of people recently, and that's dark pools. So I'm going to ask him what dark pools are, how they function in the finance market, and if they're as sinister as people believe they are. So if you like the video, please be sure to like, comment, and subscribe. You can follow us on Twitter, ihub_vision. And after a quick disclaimer, we'll hear from Clem. Please note that our videos are not designed to be direct investing advice. Our channel and our content should just be one stop on the journey of trying to find out where to put your money. Okay, Clem, so in the meme stock community like AMC, they talk about dark pools all the time. So talk to us a little bit about what dark pools are. Are they sinister pits of financial impropriety? Are they an essential part of finance? What is it that they do?
Well, technically they're pits. If you call pits trading venues, sinister, yeah, they can definitely be sinister. Impropriety, no, possibly couldn't possibly be, could they? No. So a dark pool is quite often a private venue. It can be a public venue, depends on how that venue works. But basically, if you look at level 2, and you can see level 2 on Investors Hub for American markets, you can see it on ADVFN for UK markets. There's an order book, and that order book, you can go up to that order book and you can look in it and see how many orders are on one side and at what different prices, how many orders on the sell side and at what different prices. So you can judge demand and supply, and you can go and you can put your order in on that order book to buy or to sell, or you can hit the bid and the offer. So you can be passive or active. And that's a lit book, and that's the standard book that markets have. Now, a dark pool, you basically go to the order book and you can't see anything. So you can put an order in to buy or sell, and it can sit there, and you don't know how many people are above you or how many people are below you. You don't know what their prices are. You don't know what their volumes are. And the whole point of this is, generally speaking, to cover very large orders. So you go to a dark book and you say, I want to buy, Tesla. I want to buy 1 million shares at whatever stock price is you want to buy them at. And of course, you're way off the pace, and there your order sits until the market moves and someone comes along and bang, you get filled. But they never saw that you were there. And likewise, you can be selling at whatever price you like and at whatever volume, and no one can see it until they put in an order at that price. And if it meets your price, bang, they'll get filled. And maybe the price you were prepared to sell was lower. Yeah, and maybe the volume you wanted to sell was larger or smaller. It depends on the rules of that dark pool, but you can't see what's going on. So you have to, it's kind of like a blind auction. And that's what dark pools are. Now, in the old days, if I wanted to sell 1 million Tesla, I'd ring up a investment bank and go, I want to sell 1 million Tesla, and it would call a block trade. And they'd say, yeah, I'll buy it off you at $3 off the pace, or $10 off the pace, or $100 off the pace, or maybe not much off the pace, because they wanted your business. They wanted you to keep coming back with these big orders, and they would absorb them, and then they would go and they'd ring up what was called the sell side and say, oi, we've got 1 million Tesla to go, get on with it. And they would go straight into the Wolf of Wall Street land of ringing up their clients and saying, hey, Tesla's, you really want to buy Tesla, I got some Teslas for you, buy lots and lots of Tesla at an institutional level. And what the Wolf of Wall Street did was take that system of hard selling out of the institutional world and bang it into the private investors and sell them rubbish until he got busted. But the idea of a block trade is you buy a big block, nobody knows you've done the trade apart from the seller and you, and then you go and you sell it out in your sell side to institutions, and nobody would see it. So the big order would get absorbed without moving the market. And because of that, the big guys can move in and out. Well, dark pools tries to replicate that, in a sense, in an automated market way. Now, obviously, because there's no transparency, all sorts of things can go on. And of course, even if they didn't go on, everybody would think they were going on. And of course, because it's a dark pool, you can, on the buy side, you can do all sorts of stuff. And maybe you're allowed to do that. Maybe you're not allowed to do that. I mean, you can ping out little orders you can move them up and down the book until you get some sort of fill and realize there's a big seller there, and that impacts other markets, and so on and so forth. You can buy it here, sell it there. You can buy it cheap, break it up. It's a whole big ball of wax. Now, the dark pools don't have to have the same rules. They can have all different sorts of same rules. And some of the lit pools have taken on some of the dark pool ideas. One example is what's called an iceberg order. And an iceberg, and when I used to trade the book, I used to love the iceberg orders. You say you've got, I don't know, $500,000 of stock to go. You wouldn't put, hey, I want to sell $500,000 because someone would go, oh, run away. But you'd put an iceberg order in for $500,000, and it would be, say, $50,000 or $10,000. And somebody would come along and ping that, and it would refresh. But because it refreshed, you didn't lose your position in the order book. You wouldn't put to the back of the queue. It stayed at the front. So someone would come along, not see much there, and put in an order and eat the point of your iceberg, and then a bit more of the iceberg would show. And people go, oh, there's an iceberg there. Oh, if they ever noticed it was there, of course, which they may not have noticed it was there, and go, oh, well, I wonder how big it is. Oh, okay, it's probably not that big. Buy another chunk. And then by the time they'd realised there was a dirty great order there, you'd sold half your $500,000 out. And of course, the tip might be $5,000 or $50,000 or $100,000, but the actual iceberg wasn't lit. So that's the kind of idea of the benefits or potentially the drawbacks of an unlit market. You really don't know what's going on, and that's the whole point. And that's so people who are moving in big market moving size can cover that and not cause the market to move against them when they show up and say, oh, I want to sell $500 million worth of Apple. You know, I was going to go, oh, run away. But they can put that order in a dark pool, and someone will come along, and depending on the rules, because some rules will say, unless you want to buy half of, within 20% of the volume, it won't cross, it won't settle. So you put your 500 million up there, and if someone comes along and wants 100 million or 50 million, they don't get it at that price. But if they put 400 million or the whole 500 million, or want to buy more than 500 million, they get your stock. So it depends on the rules of the dark book. But, so someone could be not knowing you were there, even though they were bidding a price above you, because their size was so small that they wouldn't set off the rules of crossing that trade. So it's a very interesting model, but obviously it's enough to make anybody paranoid. And I'm sure a lot of people are paranoid, and I'm sure some of them are right to be paranoid. There's been enough trouble and scrutiny in the whole area.
What you're describing reminds me a little bit of whenever a company will offer a particularly good deal on their stock offering to an investor that wants to buy a big chunk of their stock, but they file those publicly with the SEC. Why is it that whenever they're exchanging these stocks that could theoretically be traded on the open market because they aren't locked up within a private company, why is it that they're allowed to shuffle these around, in the dark?
But let me answer the first one. If people are issuing new stock, you have to do an announcement. So it's completely different from selling a big block of stock, because it's new stock. And if we have to tell the market, you're issuing new stock and you're diluting them. Now, someone's got existing stock, he wants to sell it. I mean, it's totally legal for him to knock on your door as a sophisticated investor or high net worth and say, hey, how would you like to buy my stock? You don't have to go through the stock exchange to do that. And so it's the equivalent of that. It's a private marketplace. And there's no rules against that. In fact, there's plenty of rules, but none against it. So that's why you're allowed to do it, because it's not the same as having to register with the SEC. And ultimately, if you hold shares and you're restricted, the value of those shares goes down. And if you're restricted from doing A or restricted from doing B, you lose a right and a freedom, and that makes what you've got less valuable. So the less rules on how you buy and sell stocks, the better. And the regulators know that. What they don't want is abusive practices. And you can go on and buy a stock in the stock market through your broker, and you can get in all sorts of trouble because it's an abusive way that you've done it. I mean, you can do it as an insider and not tell anybody. So it's going through the proper market, and that's a market abuse. And there's plenty of ways to abuse the market and be in the exchange, and there's plenty of rules to stop abuses of the lit book. So really, it's just about abuse or lack of abuse, or about rules being within the rule book, and people doing things that should be in the rule book that aren't, that need to have rule changes. I mean, there was a instance of flash trades, which was, I mean, it blew me away that they got away with it, or they were allowed to even do it, that they even thought about doing it, which was to show the price to somebody first before everybody else. I thought that was strictly against the rules, but that's what flash trading was all about, and that's what the flash boys are all about. And the exchanges were actually, even today, here's an example, and I don't see that this can possibly be legal, but they do it, which is you can go to one of the American exchanges, I think any of them, and say, I want to put my computer right next to yours, so it can talk to your computer faster than anybody else's. And they will say, yes, that will cost you this much. I mean, that's like giving somebody proprietary access. And that's not a level playing field, but that's totally allowed. And in fact, I think all of the exchanges have had that as part of their business model. So if you want to have your be a market maker and you want to have your computer be able to talk to their computer faster than anybody else, you can pay a premium to have better access. And I can't see how that's possibly legal under the rules, but there it is. It's there. And it's what is called market microstructure. And there's a lot of money to be made in understanding market microstructure. And if you don't have level 2, for example, or you're trading on a little handheld that has a big green squiggly worm as the share price, then you're going to find it hard to make money trading against people that have got their mainframe computer 10 inches away from the stock market's computer, and they've got a building full of PhDs who can tell you what the normal distribution of that share price movement is over the last 9 months and the second integral of it. It's going to be difficult, isn't it? So, one of the things that people need to do is skill up as much as possible on things like that, or don't play that game of trying to compete in high-speed trading with the people that are, not only professional, but got better equipment, got better degrees, got PhDs, and all the, research and infrastructure that you can possibly imagine. As I always say to people, I tell you what, why don't you play Roger Federer at tennis for money? And they go, oh, I would never do that. I'd never win, would I? I say, okay, so you're going into the stock market and you're playing the stock market equivalent of Roger Federer at tennis. And you're expected to win. But of course, when you get over that time horizon that all these things occur in, they can't hurt you out there, or way, way less than by going up against them. If you want to play chess with Roger Federer, you've got a fairly good chance of winning, but not tennis. So investing over the medium to long term is absolutely the best way to go, because after about a year, even the funds don't care. So if you've got a medium to long term regard for what the market's going to do, you really get it all to yourself. And therefore, funnily enough, you're going to make good returns. Believe me, I know what I'm talking about.
Hey, thanks for watching. And if you hadn't already, please be sure to like, comment, and subscribe. It's the best thing you can do to help us grow. And you follow us on Twitter. They can do that too. iHub_vision. And I'll see you again soon.